Joining us now is the chief economist at Compass Real Estate, Mike Simonsen. Mike, thanks as always for joining us, and congratulations are in order. I don't think we've spoken since the new role, so congratulations on the new role at from my perspective, one of the fastest growing real estate firms out there.
Thank you very much. It's always great to be here.
So in your new role as chief economist there, I'm sure you spend a lot of time addressing the staff of realtors at Compass. And what are you telling them here as we head into what I would assume is usually a pretty slow period of time for real estate transactions? The closer we get to Thanksgiving, I've got to imagine that's when things really dry up. But what are you seeing out there, and what are you telling the realtors at Compass?
Yeah, my job is really to help everyone understand the U.S. housing market, and that's buyers and sellers as well as the professionals in the organization. It's the fall. It's in September. We actually have a little bit of a last gasp of the housing market.
Mm-hmm.
In the U.S. there's really two markets happening right now. There's a Midwest and Northeast, and then there's the Sun Belt. There are two different things going on. And so in the Midwest and Northeast, inventory is still actually very tight. There's not a lot of people selling homes, moving, like the over the years, we've been moving north to south, and as it got expensive to move, we're moving a lot less right now. And that's not just mortgage rates, it's also insurance and all the other things. So we're moving a lot less commonly right now. It's also the job market because companies aren't hiring very quickly. We're not quitting our job in Boston to find one in Orlando. And so we're not selling our house in Boston to buy in Orlando. Inventory is at very high levels in Orlando and still very tight in the Northeast. So that's a really notable split in the U.S. right now.
I hate to get overly specific here, but I have been just amazed by what's been going on in Connecticut. It has been reliably the worst inventory situation in the country. I know this applies to most of the Northeast, but do you know if there's something unique about Connecticut and its proximity to New York, perhaps, that's making it such a difficult market to buy a home right now?
You're right that Connecticut has been like just barely maybe 1 or 2% more homes unsold on the market than a year ago. For much of the year, it was fewer homes. And so, I think that it is in this phenomenon, it's more commonly the suburban areas than the urban areas. So, for example, I was in Chicago this week, and the same thing's happening in Chicago. There's inventory in downtown condos in Chicago, but
Sure.
in suburban Chicago, it's very tight. And it's like those are the folks who were, selling and moving south. And those are the folks who are holding on still. And there may be, the city of New York has actually had, you know, uh, tight, like a reasonable demand for homes. So like, and growth in the economy. So that could spill over into Connecticut and be part of the factor that like there's less supply and demand isn't as light as it is in much of the country.
Mike, I'm aware of this story that you've told of two housing markets in this nation, the Sun Belt versus Midwest and Northeast, and just how different those markets look. And the question that comes to mind for me is why. And I've been, putting together some answers. It's a reversal of COVID trends. That's where a lot of the homes were built over the last several years. Insurance costs go up. Is there but honestly, none of those to me explain all of it. Is there a really concise story as to why the Sun Belt is seeing such an uptick in inventory right now? And is there something that reverses that trend or at least equalizes that market? Because it does not seem as though that increased volume is leading to way more transactions and way more price cuts.
Yeah, so it is, in fact, all those things. I called it the Great Stay. We are staying in our towns, we're staying in our homes longer, we're staying in our jobs longer. Because companies aren't hiring very quickly, we're not quitting our jobs. We're not, and so we're doing so. All of these things were like, it's related to COVID, and I have a great mortgage from the pandemic,
Sure.
and the companies have the right staff size from the pandemic. So all of those things, and they don't need to hire more. So all of those things are conspiring to keep us in place longer. The and so You're right. Like in the places where we've been building a lot of houses because we've been moving very quickly there. Uh, Now when we slow down that move, that inventory builds up. In a place like Western Florida, like Tampa, we have outbound migration. So Tampa is actually shrinking. We have also things like dramatically higher insurance costs.
Yes.
So, if you had a house in Tampa that you used for a couple of weeks a year, it used to be very cheap to hold that. Now it's suddenly got more expensive to hold that. So even if we're not moving, those also come back on the market. So you have all of these factors that are going together right now. My guess is, when does this change? When does it end? And when we get into a business cycle where companies are hiring again, and we are more confident about our ability to quit our jobs, those kinds of elements in the business cycle, when those kick in again, then we can move. Then we will say, you know what? Okay, I put off my move to Florida or to Arizona for 3 years now. Now it's time to move. So we're in a restricted time now, and at some point, those like the governors get lifted and allow us to start moving again.
So, Mike, I won't try and nail you down on where you think interest rates are going, because I don't know about you. I find that to be a loser's game of trying to predict where that's going to be. But can you instead try and give me a sense of where you think interest rates might need to be for people to stop feeling so locked into their current situation?
Yeah, there have been, in the last 3 years, there have been two moments when interest rates, the 30-year mortgage rate got close to 6%. And in both of those times, so it was the beginning of 23 and it was September of last year. And both of those moments turned into an uptick in buyer demand, more transactions, and actually pushed home prices higher surprisingly quickly. Surprisingly to me, I was surprised by the reaction both of those times. So I look at 6% as a sort of threshold where we start to move the needle. We start to see, oh, there's more transactions happening. People are feeling like a move is affordable. And so there's been only two moments in the last 3 years when that happened. The 6.5% is not enough. And so when rates are roughly around six, that means some people are getting rates in the fives, and those people are starting to feel affordable. So that's really a level I am interested in. What's interesting right now is that the jobs market is arguably deteriorating.
Yep.
The unemployment rate is ticking up. The hiring rates are low, very low. The job creation rates are very low. And so, does that mean in 2026, if the jobs market is worse, the economy is slower, does that mean that number needs to be even lower before we move the needle? Maybe that threshold moves lower in the coming year. But as of right now, the two times that we've gotten close to 6%, we could see the needle move on housing demand.
Yeah, that all else equal statement is all
That's right.
important right now. Mike Simonsen, chief economist at Compass, joining us today to talk about the state of the national housing market. I really appreciate you coming on, Mike, and we'll talk to you again soon.
You bet. We'll talk soon.